Thank you to the Society for having me speak today. As you mentioned, I'm on the commodity strategy team at RBC Capital Markets. I specialize in natural gas and gold, as well as some broader commodity themes, but I'll be specifically focusing on gold and natural gas today. You know, and today is just as good as any, I think, this year for the commodity space, in particular, to be chatting. Commodities have certainly been in the limelight this year, and that's really been the case pretty consistently, but in varying capacities. Today, I'm going to talk about the global natural gas landscape, specifically as well how it relates to the U.S. as well and our outlook there, and then probably perhaps not so gracefully transition to talking about gold, but then I'll open it up for a few minutes of questions at the end, and I'll kick it off with the question that you had just asked. In the context, in particular, in the context of the Russian invasion of Ukraine, a global energy crisis, rampant inflation, most of the natural gas conversation this year has been centered on high market prices in the U.S. And abroad. We've seen a bit of relief, at least in energy and natural gas in particular, more recently, but I think it's really important to frame where we're at today in the context of gas's journey so far this year. Where it's at now, as well as the risk sort of going forward. And likewise for gold, the early part of the year certainly saw a high, but it's been a bit of a grind lower from here. So when I get to gold, I'll also be sure not to sort of skip that context as well, because I think it's important, setting the stage for where gold I think will go, particularly through the end of this year and into early next year. But first, I'm going to start with natural gas, particularly amid the ongoing energy crisis in Europe specifically. TTF, which is the main European natural gas benchmark, like many other commodities, has experienced immense volatility and very high prices earlier this year. And it's really been for a number of reasons. While prices are certainly down in the context of the price cap conversation, the market intervention conversation, high storage, and a warm end to the injection season, it really is quite hard to put a market-based roof, I think, on European gas prices or TGF at the moment, given the sort of limited supply options from here. And the fact that we are already facing sort of large voluntary and involuntary demand destructions. Plus, there's the risk that what little Russian gas that does still flow to Europe at this very moment could be shut sort of at any moment, if perhaps not the worst possible moment this winter. For those who are maybe new to the space, it's important to keep in mind throughout this conversation that natural gas demand rises significantly in the winter for heating in particular. Most people I talk to have accepted that a shutoff is reasonably probable to happen. And so again, I think that's an important level setting note to have as we continue this conversation. Historically, Russia has supplied around 30 to 40% of the continent's gas. Russian gas shipments are down more than 90% now, having fallen well below the 300 gigawatt hour per day number from over, I would know, like essentially 4,000 in November of 2019. So that's obviously a very significant decline. And now we are well into the single digits as a share of the EU's import stack. This has been due to a cocktail of weaponization, sanctions, and infrastructure damage, especially at the beginning. But really, I would argue throughout the crisis, I would get questions about what sort of financial sense it made for Russia to shut off gas exports to Europe. The reality is that it doesn't really make financial sense, at least not for the exporter, but the Kremlin is a different story. Far more of the Kremlin and thus Putin's hydrocarbon revenue come from oil than gas. So it's really a much cheaper option for Russia to have and continue to weaponize to punish the EU for its supporting of Ukraine. It was never really about optimizing finances. It was really about sort of the geopolitics of the situation and Putin's goals in Ukraine. And again, I cannot underscore this enough. Gas has really been that sort of cheaper option to weaponize versus oil, and that's really sort of underlying this ongoing energy crisis that is perhaps most acute in Europe, although there's certainly been energy stresses broadly globally and here in the U.S. as well. anyone who's been paying attention to space is aware, headlines about Russian gas shipments have rolled in repeatedly this year. Nord Stream 1 was shut in, and then most recently was sabotaged with the underground explosion. Nord Stream 2 clearly is not coming to market. The Yamal route, which in addition to Nord Stream 2 is one of the 3 main routes that were sending gas shipments into into the EU through Poland, has actually flowed in reverse in small volumes. And the only flows that are actually still going from Russia into the EU of the major 3 routes is one delivery point essentially coming out of Ukraine, which is subject to what should be obvious risks as well as we think about when we get to sort of peak demand this winter. That's something important to not forget. As far as sort of dealing with this crisis and the weaponization of more than a third of the imports that had been going into EU, the European Commission has really dealt with the crisis through a number of plans. And I do not envy their position. I think the strategy to deal with the crisis has really been a sort of kitchen sink approach. That's the sort of only way they've been able to prepare, at least in part, for a no Russian gas world. And it's really centered on securing what pipeline supplies they can from Norway, Algeria, Azerbaijan, a couple others, but mainly ramping up LNG imports. Of course, the U.S. is the world's swing supplier at this point and has clearly played a role. I'll be getting to that more in a bit. But the continent of Europe is trying to secure supplies from wherever they can get it. Right now, most recently, we've talked about pooled LNG procurement, dynamic price caps to limit the end prices for consumers. The deadline for a lot of the stuff they've talked about more recently has actually been pushed into late November. I believe it's the 24th. But the reality is that they have achieved quite a bit in rebuilding storage north of 90%, which is impressive. That was certainly helped by the warm start to the winter, or maybe more accurately, the warm end to the injection season. And it's opened the door to some of the gas price relief we've seen, but going forward, there are still the challenges in getting gas, period, but also getting gas to where it's needed most in the UK, or in the EU. Most of the slack in LNG import infrastructure is not necessarily where it's needed most. Most of the slack historically has been in places like the Iberian Peninsula, Spain in particular, France, the United Kingdom, Italy, not sort of Germany and Eastern Europe, which as a share of supplies has historically gotten a lot larger, or a much bigger share of its gas directly from Russia. To date, they have secured LNG and pipeline supplies, but this sort of large shift doesn't necessarily happen overnight, and certainly not in the volumes necessary, perhaps, that not have any disruptions. And it leaves open the sort of question of what balances will look like this time next year. But for now, this year, it looks like they will make it, maybe perhaps a bit painfully, namely due to their sort of kitchen, again, I mentioned this before, the kitchen sink approach to dealing with the crisis. The EU has worked immensely on demand reductions, both voluntary, and because of prices, there have been a lot of involuntary demand destructions. Some of the voluntary movements have been limited temperatures in public spaces, campaigns to do the same in homes. EU countries have prioritized industries in the event of further restrictions. They themselves have really driven this voluntary and involuntary demand destruction, which has clearly disrupted some of the industry that depends on gas and power. Anyone listening, I think, today has certainly seen some of the estimates for hits to economic growth. So while overall Europe is facing down a winter with very little, if any, Russian gas volumes, they have successfully rebuilt storage through the aforementioned demand destruction, which has mitigated some of the loss of gas volumes and helped them rebuild storage to essentially 94%. And again, they will likely be able to weather the winter, but it's going to be painful. Part of the new supply picture has really been around U.S. exports of LNG. Around 60–70% of U.S. exports went to Europe last winter. Generally, I think from the U.S. perspective, between European utility contracts and the more flexible volumes from U.S. exporters, mainly going to portfolio players, we think around 80% can go there, depending on pricing and need. But that doesn't necessarily mean that the U.S. exports more gas. And this is an important point that I'll talk about quite a bit in a bit. LNG, cargoes have increasingly gone to Europe, but this winter they will again be bidding for cargoes against Asia. So again, while prices may be experiencing a period of relief at the moment, similar to the story I'll tell you for U.S. gas prices, we wouldn't write off the sort of higher prices and winter volatility that many people expect in the market. The reality is, though, when we think about U.S. LNG exports as a solution for Europe, it's certainly been part of the solution, but there is a limit, and that's the physical capacity limit. The U.S. can only export so much. So no matter how loud the sort of siren call gets from Europe for U.S. exports, there's a specific, I think, and at times exaggerated impact on U.S. prices. And so this is where we sort of get into the U.S. balance and U.S. price portion of this presentation. And so again, U.S. LNG exports have a hard cap. Most of this year, we've seen U.S. export infrastructure operating at around 94, 95, even 96% utilization of available export capacity after adjusting for the Freeport shut-in, which is still supposed to return in mid-November, but there are questions. So high utilization has been a fact year to date. It's been a fact for quite a while, and we expect that to remain the case on an ongoing basis. But again, U.S. LNG export capacity is a hard cap. There's no surprise infrastructure coming online. It takes years to build these facilities. So whether European gas prices are 100 euros per megawatt hour or 2, 5, 600 euros per megawatt hour, it's not essentially, for the U.S. perspective, going to mean a large incremental difference in the amount of gas that is exported in total. So I think a lot of the volatility that we saw on the back of some of what was happening in Europe this year was a bit over-exaggerated. We saw, what I would argue were exaggerated geopolitical premiums in U.S. gas markets, which are admittedly more retrenched, closer to zero recently. But as we get into the winter, the reality is it's like as much gas as can go to Europe will go to Europe, and that's going to be the case in almost any conceivable scenario, particularly as they bid against Asia for spot prices. So in the EU, I think this sort of adds up, and I think it should underscore that I do think it's difficult to put a lid on the risk for EU gas prices. We will continue to see it fluctuate with headlines about what remains of the Russian flows into Europe. It will fluctuate with the conversation around EU policies to mitigate high prices and their plans, I think, for gas infrastructure more broadly. But the balance is tight. There's no really panacea. And again, I think EU prices should still be thought of as vulnerable, even though prices have come down quite significantly, I think, more recently. Now, to talk more specifically about the U.S., similarly, we've seen quite a bit of volatility in U.S. gas prices and much higher prices earlier this year. It's nothing like what we saw elsewhere and in Europe in particular, but that perhaps was no solace to the U.S. consumer and the consumer landscape, which was looking at U.S. natural gas prices in sort of the $8, $9, and closer to $10 per MMBTU range, a price that has not been experienced in nearly a decade. So if you look at a seasonal graphic of U.S. gas prices at Henry Hub, which is the major U.S. benchmark, you can see that at multiple times, they've been experiencing multiples of what prices people had gotten used to in recent years. And again, this has come down more recently, down into the sort of $5 per MMBTU range. And there are a few reasons for that. One, mainly I would say, is production growth, which lagged in the U.S. earlier this year, has actually been slowly grinding higher and is now providing some relief, particularly in the context of what's happening on the demand side. As I mentioned before, LNG export infrastructure has been highly utilized year to date. This has certainly provided some relief as well. Coming from what has provided relief is the Freeport LNG facility certainly came offline after explosion this summer and should remain offline until at least mid-November. Cove Point, another facility, had been down for some maintenance. That has added some relief, but LNG had been highly utilized earlier. At the moment, it's adding some relief given some outages there. And earlier this year, I think most importantly, was that the summer was extremely hot. It drove record power burn for natural gas on particular days and months. And it really, what's really changed is the start to the winter season, or I guess, again, the end of the injection season, has been especially warm overall for the lower 48, and that, again, has provided relief. So we are experiencing some temporary relief in LNG. Production has grown, and weather has certainly loosened the balance as well. And this has all added up to a string of higher than normal storage injections late in the season, which have led most people and market observers to view the balance as much looser than they expected. I'd say that most recently, prices have changed more than fundamentals did in a sustainable sense. So I still wouldn't write off higher prices this winter, even if they don't necessarily reach the previous highs in any sustainable way. I do think prices have overshot to the downside, even after some of the moves we've seen in recent weeks. So overall this year, though, there's one thing that I think is particularly unique for natural gas at the moment, and this is the sort of new world of macro and geopolitical headlines that are having an impact on U.S. gas prices, namely to the upside for most of this year, but also in a more mild sense, which we're seeing right now. You know, natural gas markets were not unique in the fact that they were having these sort of exaggerated and repeated volatility on the back of macro news, geopolitics and the like. In fact, it's harder to find an asset that hasn't been experiencing some element of that right now. But what is unique for natural gas is the sort of global sense. It's a more unique phenomenon that we're experiencing this type of volatility in what historically has been a far more regional market. LNG exports have certainly connected U.S. balances abroad. And so before, what happened in Europe didn't necessarily matter in the United States. And now there's more of a fundamental justification for some impact on U.S. prices from what's happening abroad. But my view for most of this year has been that it's been far more exaggerated. And more importantly, I think most of the upwards momentum in U.S. natural gas prices earlier this year was because tight balances really left U.S. gas prices vulnerable to these external pressures. Arguably, the mirror of what is happening right now is balances have loosened and geopolitical premiums have dissipated. But the reality, I think, is the room for that exaggerated impact is mostly due to tight U.S. balances versus really what was happening abroad driving it on its own. So from here, we do expect continued slow but steady production growth. Producer action is admittedly still based around living within cash flows. They're not really remunerated for pursuing production growth for production growth's sake. Additionally, just like every other part of the supply chain in the world we currently live in, they are facing cost and labor pressures. The labor market is tight and expensive. Inputs like steel are expensive, and it's even hard to find things like truck drivers on their end. So we don't anticipate a massive swing on the production side. The growth has finally come, I think, in terms of volume in a more calm fashion, and it's more of what we expect on a going forward basis. What hasn't been calm recently is really demand. I mentioned LNG already. Highly utilized and steady in that sense, but very highly utilized. But really the strong power demand this summer that I mentioned earlier was a lot of what drove some of their vulnerability, I think, in U.S. balances. Coal markets were tight, supplies have been low, and natural gas really bore the brunt of a hot summer, more so in my view than it otherwise would have. And we saw, again, really high power burn for natural gas, particularly this July, as well as some other months this summer. And all really added up to a weaker than average injection season earlier this year. We're just happening to see it sort of catch up now, and we're now at the 3.4 TCF mark, which was better than most people expected at the beginning of this year, but worse than perhaps I expected at one point. So while we're sort of somewhere below this time last year in the 5-year average, U.S. balances are somewhat tight, but I think right now the market views them as much looser than expected. That's, I think, why gas prices have traded down as much as they have, given those elevated injections. And in our view, a lot of the action that we've seen this year has been exaggerated. Gas, I would argue, had traded way too high this summer, and more recently, I think it fell below its fair value. We did an analysis on gas's price relationship with storage, and specifically the 5-year surplus or deficit to the average. Storage is sort of the balancing mechanism for gas markets, and thus is very important to the price discovery process. And what we found was that from February 2021 to today, there was a much steeper relationship between those two dynamics, between prices and the storage deficit to the 5-year average. And that can be observed in the much larger swing in natural gas prices that we saw. When we compare that to sort of any other window going back to 2015, it was particularly meaningful in the context of this volatility that we saw in gas prices, which again was mostly to the upside earlier this year. Right now, it seems like it had been to the downside more recently. We use this analysis and the regressions created on the back of it as well, I think most importantly, to come up with what we viewed not just as fundamentally justified prices, but also to help us identify what the macro or geopolitical premium in gas markets was. And when gas was at its peak, it was closer to it was in the $2 to $3 range. It was $2.29 at the end of August, and that's a price that we didn't think was particularly sustainable. And so while I think that has certainly come down when we're talking about prices in the $5 range, our Q4 forecast is $6.77. I think that's indicative of the upside that remains for this winter, particularly because I don't think we can write off volatility. It was exaggerated earlier this year. Just because it's come down now doesn't mean it can't materialize again. And we can't say if that headline in geopolitical impact is going somewhere. But I think where we've found ourselves in is a cleaner price level to really begin the winter at. We'll likely get some sort of winter spike in U.S. gas prices. I think that presents plenty of opportunities this winter in terms of trading. And I think the ultimate outcome for gas next year really depends on how cold this winter is and what shape balances exit the withdrawal season. So at this point, I'm going to make the sort of not so graceful transition to talking about gold. Gold, I think, is yet another asset class that's experienced quite a bit of volatility, less so than gas, but we've certainly seen some pretty high highs earlier this year, and a really strong ongoing grind lower, I would say, more recently. I tend to have one of 3 different conversations these days. People that I talk to are either disappointed or perhaps upset about gold not performing. Another is sort of confused as to why gold is moving the way it is, and the other is more apathetic or defeated, and people just asking out of necessity for gold. So what I really want to do here is take a step back for a moment and talk about what gold is, less about what it's doing today or tomorrow, and more frame gold's behavior on a go-forward basis. To date, I think it's really been a tug of war between gold's most important macro drivers, which have pointed to lower gold prices, and sort of perceived safe haven, high risk inflation story, which continues to drive some perceived safe haven and store of value allocations. But what's really winning out right now is the macro drivers for gold. It sort of gets us to one of the categories of the conversations, the ones that are disappointed or confused. It's sort of like an if not now, if gold isn't performing now, why should I make an allocation to it? That results in some reluctance to make such allocations. But one thing that is also particularly important in this context of the tug of war that I was talking about is gold is a shock-driven asset. The daily price discovery process may be about what's sort of happening on the macro side, but sort of surprises in data, and Fed speeches and what that means for policy are important. But in times of crisis, I think gold has an important role to play in terms of performance in portfolios. So I'm going to go sort of line item by line item here in our view for gold, and hopefully it adds up to what I think is the important context for gold's performance. So in a macro sense, there are a few things that are quite clear, right? The dollar is strong, may be down more recently. Rates are high, also may be down more recently. But those 2 factors are the 2 most important macro factors for gold. Rising rates, I think we can debate about what size a hike will be and for how many more hikes we will have. But what's clear is from where we are right now is not only have rates risen, but there's still room to run. The dollar is so strong that that also is certainly leaving gold vulnerable. And what we've really seen for gold is, regardless of the sort of risks that are happening, regardless of inflation, regardless of the potential for ongoing crises, those sort of macro factors that are important, usually negative drivers for gold when they're moving higher due to long-running correlations, those ones are really in the driver's seat at the moment. And so I think still, investors who are looking for higher gold prices or believe gold should be higher based on its long-held reputation when it comes to inflation and crises. There's some important points I think that we must say. So first, obviously in this world we have to talk about inflation when it comes to gold. Inflation. Gold has a reputation as a hedge against inflation. My view is that it's not necessarily the best hedge against all types of inflation. There are clearly plenty of instruments created for the very purpose of hedging against inflation, particularly CPI. Gold tends to be a good hedge against extremely high and surprise and uncontrolled inflation, which there is an argument for that's what we're experiencing right now. But most importantly, and I think a better argument is gold is a better hedge, in my view, against the more monetary flavors of inflation, something more driven by money supply, something purely of a monetary sort of origination, rather than the sort of natural resource supply chain driven inflation that we're seeing today. So while gold sort of over the long term is thought of as a money and a good preserver of value over the long run, and it's not necessarily the perfect hedge against all types of inflation at all times. And I think in particular, not the type of inflation or flavor of inflation that we're seeing today. That's the explanation I've offered to those who are frustrated by gold's lack of performance in regards to inflation. One thing as well on the other side is we're talking about risks and crises. Gold's reputation, long held as a perceived safe haven, is deserved, but I think it's nuanced, and this is perhaps the most important point that I can make for gold. So we've done analysis where we have analyzed gold's performance in types of crises, various types, and gold tends to perform well regardless of the type of crisis in the short term. But over the longer term, the more durable performance depends on financial and economic fallout. Again, we've done analysis going through a lot of different crises back to the 1970s, and over the 1 month, 6 month, and 1 year timeframes after various crises, we've seen average performance is typically higher for those, again, with financial and economic consequences. I say that, and I've been asked point blank, well, if that's the case, COVID and Russia's invasion clearly have had financial and economic consequences, so why isn't gold much higher? What we can't forget is what makes, I think, this period unique versus some of the other crises is economic fallout is normally or usually thought of as driving an environment that requires rates to fall, and perhaps one where the dollar is not particularly strong. Right now, the fallout has really resulted in an environment where rates are not moving in gold positive ways as we try to battle inflation. And so, and likewise, the dollar is not weak, it's quite strong. And so this is an example of, despite there being financial and economic fallout, it just hasn't shaken out in the ways that we may think of in a type of crisis. It's not shaken out in ways that are perhaps the most important, that are positive for the most important factors or macro drivers for gold. So overall, we have gold largely trading sideways through the end of the year. We're in certainly the mid 1600s today, where I think we're a couple dollars off of our actual Q4 long-held Q4 forecast of 1663. So clearly, I think from gold's perspective, we're in a pretty fairly valued territory. That said, because of the ongoing risks out there, spanning from the ongoing land war in Europe, U.S.-China tensions over Taiwan, economic risks as the world's central banks battle inflation, we are recommending gold as a risk overlay. We do believe it deserves an allocation, albeit should be thought of more of a hedge than necessarily an alpha generator in portfolios. And again, I think embedded on that view is it's not to say there's no scenarios where gold goes higher, or that it can't test the highs earlier seen this year north of 2000. It's just that right now the market does not seem to be pricing gold on the back of risk. it is certainly pricing gold on the back of macro drivers, which continue to point to sort of sideways lower gold prices through next year, but certainly prices around where we're seeing right now this year. And in our view, for us to really move away from that, for the market pricing mechanisms to move away from that, I do think it would take yet another crisis or a significant deterioration, and not just any, but one sort of on the higher level of what we've experienced more recently to really move to a higher scenario for gold prices, just given how it's priced year to date and sort of how the price discovery process has unfolded. So in closing, and before I get to questions and answer the question that Mark asked earlier, as well as any questions that you have, to wrap up, I'd say generally commodities obviously have gotten a lot of interest lately. I've had a lot more one-on-one conversations with new portfolio managers, analysts in the space than ever before. For the commodity space as a whole, I think fundamentals do look pretty strong. In a lot of ways, they're being outweighed by what's happening in a macro sense, what economic prospects look like. And there's truth there, but I think for natural gas and gold in particular, fundamentally justified price levels are much closer to where we're trading right now than they have been for most of this year. And while I do think that there's some upside risk for gas, generally prices should skew lower thereafter for the spaces I cover, including gold, absent significant geopolitical risks, which again, we cannot write off materializing. And there are numerous macro risks that we're all aware of too. So it's a bit of a high risk environment, even if macro trends continue to point to a grind lower for another commodities, gold in particular. I'd say gas volatility isn't really going anywhere in the near term, at least for this winter. And for gold, again, while I do think we trade sideways this year, it's difficult to not recommend it still as a risk overlay, given the risks out there. So I will stop here and sort of we can open it up to questions. I know we covered a lot of ground today, so thanks for sticking with me here. But the question, and I'll answer the one question to get it started while any others get queued up. Regarding whether regarding whether Bitcoin should be viewed as a commodity or not. That's a great question. I would say my answer has, some people still think of gold as a FX asset versus a commodity. So there's precedent, I think, for not to have a clear answer here. What I will say about sort of Bitcoin and gold in particular, because they've been compared historically, people have viewed cryptocurrencies as sort of a digital gold alternative. What we found is that while there is quite a bit of overlap in the sort of Venn diagram of investor psychology when it comes to the two, a lot of times both investors in Bitcoin and gold are looking for something that's not the liability of someone else, for something that's stateless, for something that they view as non-debasable and sort of a currency-like asset. That's all true. But when it comes down to the role in the portfolio and the correlations, they're not necessarily one-for-one replacements. I'd argue that there's an additive place for them both in most. So there's no really real placement for Bitcoin and gold. So in that context, maybe cryptocurrencies aren't necessarily probably aren't commodities, but that doesn't mean they don't share some similar aspects at certain times. So I'll stop there. Hopefully, people had a few moments to come up with some questions, and I'm happy to answer whatever y'all want to know.
Chris, thank you very much. That was excellent information. First question we have is switching to green energy a valid strategy to solve this energy crisis and prevent reliance on Russia? And I suppose you could probably extend that to Middle Eastern sources of energy as well.
I think particularly earlier in the outset, I'd say it was a Q1 or Q2. I'll use Europe as an example. The REPowerEU plan was launched as one of the first sort of major policy movements from the European Commission to deal with the energy crisis. And what it included was, obviously Russia was cutting off natural gas exports. They're expecting far lower natural gas. what happened in that was is a system of doubling down on renewable energy, focusing on building out heat pumps, installing as many solar panels as possible, installing wind turbines, building out sort of that broader power sector energy efficiency moves, like replacing heating and cooling and basically the entire sort of demand stack. Certainly doubling down on renewable energy, but at the same time, trying to find other sources of natural gas. And so, I think if we, it seems like many years ago, but if we rewind back, when other countries were arguing that Nord Stream 2 maybe wasn't the best plan for Germany because of the geopolitical dependence that it would just further for Germany in particular, but arguably Europe as a whole, and the search for sort of cheap natural gas supplies so they could shut down coal and nuclear in an attempt to move towards a cleaner, greener future. That obviously didn't pan out. The coal, because of the unavailability of natural gas and the inability to sort of build that out as a stack, coal is living on longer. Nuclear, which I'll put to the side, is also staying online longer than expected. And what we've sort of ended up with is a sort of kitchen sink approach. And this reminds me of the sort of Obama era all of the above strategy to achieve an energy transition where natural gas is part of a sort of a bridge fuel where renewables are built out. I think that just continues to happen. What's changed more is, I think, the urgency of that shift, clearly in places like Europe. There's some people who have used the sort of crisis to say, like, look, like we should have focused on fossil fuels all the time, or this whole time and not focus on green energy, or on the other side saying we should only focus on green energy and not do anything with fossil fuels, like end it immediately. But I think the reality is we've sort of ended up in sort of this in between all of the above scenario to move towards an energy transition that is inclusive of at least a bridge fuel in the meantime, as namely natural gas, as we continue to build out renewables. I think we've seen that debate play out in Europe, and it's not necessarily dissimilar to the debate that's playing out everywhere as well.
Thank you. Another question. So recently there was reports that there were backlogs of liquid natural gas in ports in Europe because they didn't have the port infrastructure in order to accept them. So there's like boats sitting outside because they can't be accepted. Can you talk a little bit about the ancillary infrastructure necessary to support more independence from the Nord Streams that they're seeing in Europe right now? Because you talked a little bit about storage facilities, but also there's other mechanisms. You talk about truck or lorry drivers if you're in Europe. Those kinds of situations. Can you give a little bit more context into what you see from that perspective?
Yeah, the challenge for Europe, is reorienting an entire sort of energy infrastructure in the span of months or a year is not an easy task, and something that they've done a lot with, but obviously can't reorient overnight. The reality is Russia supplied 30 to 40% of the EU's natural gas. There's no sort of way around that, and finding another source immediately is difficult because your other import options also have their capacity limits. And what we've seen in particular, and I mentioned this before, is some of the issues in Europe, not just building regasification infrastructure and having the necessary capacity at ports to handle additional regasification, but also getting that gas to where it's needed. I mentioned at one point, I think, the most of the slack in a lot of the LNG import facilities in continental Europe have been in places like Spain and France and Italy, not Germany and Baltic states, where the major pipelines from Russia went through. So we're getting that gas from the places where you in theory can import it to the places where it needs to be consumed is also a challenge. And so it's sort of reorienting sort of the pipeline conversation or the infrastructure conversation. They have made some progress in getting some other pipelines online, but none of this sort of moves overnight. That's the reality of sort of infrastructure conversations more broadly, right? And so I think, that again is part of why, because of those constraints, because of constraints at the ports and getting gas from those ports to where it's needed, that's why again it's sort of been this kitchen sink approach that has included demand destruction, voluntary and involuntary, as well as all of these other policies and accelerations of other policies as well, essentially policies on policies to help deal with the crisis and mitigate some of the impact, because it's been successful as dictated by high storage inventories and prices that have come down more recently, but the landscape is still tight, and this winter hasn't really happened yet. So that certainly remains to be seen.
Can you are there any differences from a political perspective as it pertains to how Europe's looking at, building out that infrastructure versus how, say, North America is building out that infrastructure? Politically, there's balances here, at least. Most recently, the Enbridge Line 3 pipeline issues, and obviously that speaks to a little bit more on the oil side. But are there discussions politically about that motivation that might accelerate this kind of development of infrastructure to have more energy independence? Or is it kind of the same and there's a little bit of butting heads?
I mean, in politics, I guess there's butting heads all the time, right?
Yeah.
Not to take the easy way out. We've certainly seen in the U.S. a sort of reorienting of some focus, at least on the domestic infrastructure, but they're very different conversations, right? When we're talking about EU as a major importer and North America largely as a major exporter, is the conversation that we're having. I think if things get tight or prices rally significantly from here, I think that sort of changes the conversation. It depends where we're at in the election cycle. So all of this can sort of change more broadly. But again, I think there's a broader focus on sort of energy holistically. That's probably common on both sides, but to compare the two, given the wildly different areas they're in, it is a challenge. But we've certainly seen the U.S. Try to work with European counterparties to help them get more gas, not just from the U.S. but from abroad. We've seen sort of the State Department working there and things like that. So there's quite a bit of international cooperation. They have the U.S.-EU Energy Security Task Force, which I might be naming incorrectly. For energy security as well. So there's a broad focus, I think, on a national level that's certainly held in common, but the exact solution is certainly going to look different for everybody.
Can you speak, is the industrial application moving to gold? Is the industrial application of gold even worth a conversation, or just due to the price point, it's not necessarily all that viable? Can you speak to that at all?
Yeah, so as a share of supply and demand, if we think about gold, most of the sort of daily price discovery process is determined by investors, how they're trading based on risk, on macro factors, on the dollar, on things like that. That's certainly true. But the consumer aspect to gold is also relevant. I would just say perhaps in a less immediate sense, but still relevant, I think, for the price discovery process over the longer term. You can think of like most of the gold that's ever been mined still exists in the form of above ground stocks. So you're adding to that stockpile every year through new mine supply. And of that new mine supply, quite a bit of it is going into jewelry mainly, and then the other sort of industrial or consumer applications for gold, whether it be bars and coins, actual technology, industrial applications, some other things. One thing that certainly stands out to us is on the consumer side. Gold prices have clearly come down from a high, at or above $2,000 per ounce in U.S. dollar terms earlier this year. We're down into the 1600s. What, however, is not down so much is gold price in other currencies, given how strong the dollar is. So your key consuming areas like China and India and even Europe, adding on to this context of sort of inflationary dynamics happening everywhere and reducing incomes, you're also having this, from their perspective, inflated gold price given the FX moves. And so that has certainly impacted gold as a consumer good. Is consumer demand falling off a cliff? Not necessarily. Is it the be-all, end-all for gold prices? By no means. But it's an important part, I think, in the longer-term gold picture. And right now, I think it looks more expensive as a consumer good than some people realize. But the reality is like at the end of the day, it's still, at least for the end of through this year, through our forecast horizon, the investor is still in the driver's seat, and that really depends on sort of what happens economically, how much further rates rise, and what sort of risks actually do materialize at the end of the day. What sort of economic outcomes come to pass, as well as sort of what Russia, China risks also come to the market's attention. And so while the short answer is, yeah, consumers still matter, just not as much. There are some interesting underlying stories happening there as well.
I don't see any more questions in the chat. So Chris, just kind of, buttoning up on a couple of different main thoughts. What are you really paying attention to over the next 6 to 12 months? Obviously, the geopolitical situation in Europe is going to be significant, but can you get even a little bit more granular in terms of what kind of impacts you're interested in watching?
Yeah, you named it. Obviously, sort of the war in Ukraine and Russia has clear impacts for EU natural gas balances and prices. That filters into the U.S. through LNG, but that also has broader implications, I think, for inflation and for economic growth and economic risk broadly. So it kind of touches sort of everything. I think more specifically when we are thinking about natural gas, I think domestically, where we've seen sort of two extremes. I mentioned this summer was particularly hot. That drove incredibly high gas prices, left U.S. gas balances vulnerable to geopolitical premiums from abroad. At this very moment, we're not in that space. Balances look much looser than people had expected earlier. But when we get to sort of the winter, how cold, a natural gas analyst can blame weather for a lot of things, but how cold the winter does get, if it's warmer than normal, colder than normal, warmer or colder than normal, that has clear implications, I think, for where balances are set up for 23 and then into 24 as well. And so if we have this type of warmer than normal weather that we've been experiencing lately throughout this winter, I think we're in a much looser gas price picture. But if we're in a normal scenario, that underscores where our sort of upside risks that we've been highlighting for natural gas, I think this winter stands in that sort of 6-month time frame. I think for gold in particular, if the Fed pivots, that's very consequential. And similarly, if the worries that we're reading about in the New York Times and every other newspaper when it comes to China and Taiwan, if that becomes more appreciated by the market, I'd certainly keep an eye on that. So those are sort of bigger picture issues that will be impossible to avoid, but I think we can't forget the sort of more immediate impacts on commodity balances, and in my case, gold and natural gas specifically.
Sure. One other question. Are you seeing any impacts of climate change as it pertains to exploration, both from a natural gas standpoint and from even a mining standpoint? In terms of where they're looking, in terms of methods, in terms of how that might be changing the dynamic of the exploration side of it?
That would be a better question, I think, for an equity analyst who's covering the companies and what they're actually doing. But I think one particular focus that has been certainly increased, I think, in commodity space is on critical minerals, and sort of redefining the importance of natural resources when it comes to the transition, and a reminder that the transition isn't necessarily reducing the consumption of all commodities in theory. And so a focus on energy security is no longer just talking about oil and natural gas and coal. It's also energy security is also a conversation about minerals. So I'd say like that sort of the climate change transition impact on the commodity space has certainly been enlightening, and that's introduced metals into the energy story.
Great. Are there any other questions out there from the attendees? I'm not seeing anything. Chris, extremely informational. Mr. Salter, I'll turn it over to you.
And thanks, Chris. Your questions were much better than mine. Much appreciated. So yeah, last call for questions, guys. Otherwise, we will give you back a couple of minutes in your busy Thursdays. And not seeing anything come in. Okay, with that, Mr. Louney, thank you so much. Really appreciate you sharing your thoughts and your perspectives. And everybody, I don't have a good pithy group send off for you, so I'm just going to say thank you once again and enjoy the rest of your day.